Huge news this week in early November. You may not have heard about this, but the Fed cut rates again. Yes, there was a little election that I'm sure that we'll talk about too, but we'll also be covering some information on the recent 25 basis point interest rate hikes and its implications for commercial real estate, some of the jobs data and economic data that could be pointing to some interesting times, to say the least. And obviously, we will get to the milestone election of Donald Trump and the massive implications for the CRE market. But it's worth noting that the commercial real estate market was already in the midst of a massive transformation. But we'll also be getting into a landmark report that's been getting a lot of attention amongst CRE investors and real estate investors in general. PwC and ULI's emerging trends in real estate for 2025, which points to improving prospects for CRE investment and a more active market for commercial real estate and multifamily specifically. Important events and major research have been coming in fast. We're keeping up with the best, most important information and insights on multifamily, CRE, housing, and the economy on the Gray Report. Let's get started. Hi, welcome back to the Gray Report. I am your host, Matt Bosnagel, filling in for Spencer, and I am joined today by the ever-poised Addison Lubert. He is on our acquisitions team, and his intelligence, quick wit, and conversational acumen are unmatched at Gray Capital. It is a pleasure to have you here, Addison, and I look forward to the insights that you bring to the Gray Report.
It's a pleasure to be here as well.
Oh, thank you. Do you have any general comments before we begin, or should I just dive into this Federal Reserve announcement made of 25 basis point rate cut? And yeah, we could just talk about that if you want, or if you've got something that's been nagging, then we can just bring it up now and.
No, I mean, I'm excited to get into the Federal Reserve.
All right, let's get into it.
I mean, I can't, aside from the college football rankings and the return of midweek Mid-American Conference football games, I can't think of
nothing's more exciting.
Anything else that happened this week.
Yeah, nothing really major. I guess I just don't follow the news. Just kidding. We follow all of the most important news, and we'll get to it in just a second. Yeah. We know there was an election, but news, research, and reports come at us fast. We are holding on to the best and most important each week, and we're presenting them at the Gray Report. So I kind of lead in with this Fed announcement. I know there's an election. We are going to talk about it, but I don't know. I wanted to go against the grain here, and I like to think Jerome Powell needs a little bit of attention too. So I'm going to bring up this visual here, and the visual is on the market yield of 10-year treasuries compared to the federal funds rate. We'll see it right here. And now I can be mistaken here. Now there's a little dip here, and you see that dip represents the 25 basis point rate cut from the Federal Reserve. And here's the quote. In support of its goals, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.5 to 4.75%. I brought up this little visual because I wanted to, I just wanted to show how the 10-year Treasury, yes, everyone's talking about how the 10-year Treasury is higher right now than it was, or than people maybe have expected it to be, but it does run essentially in step, maybe not lockstep, but it does mirror the federal funds rate. As the federal funds rate go up, the 10-year does, and it does seem like more often than not now. This is my in the moment technical analysis. It does seem like it's very rare for the Fed funds rate to be above the 10-year Treasury. Usually the Fed funds rate is a little bit below, and now there's select moments, and they always seem to precede recessions, or at least the last two recessions, we had these moments where the Fed funds rate was briefly above the 10-year, and then, I don't know, the shadowed parts of the Fred graph that we always see that indicate recessions. Now, there's lots of doom and gloom thinking that you can have, and I will also allude to the similar patterns that you could see in graphs on the job market that could make you think, oh man, are we really headed to recession? But I think that there is enough weirdness about it. It's not every day that you get a pandemic, and we're still dealing with that. I know the actual pandemic is over, but the size of these changes, and I had to actually, when I was coming up with the graphs for this week, especially for jobs added, I had to trim the graphs because otherwise the spike and drop in jobs added during the early moments of the pandemic meant well, it just looks like straight. Everything looks like straight lines.
Yeah.
Comparatively. So, just in these little things alone, we are still dealing with the after effects of the pandemic. One of which is inflation that Jerome Powell says is going down, and also I will. This may be the first time. I don't know if we have had this election. And it has essentially flipped government control to Republicans. And you could argue that has had an effect on economic sentiment. Now, we covered economic sentiment last week, and there are a number of measures that show that people's feelings, call it consumer confidence, consumer sentiment, whatever, people's feelings about the economy are already improving. Maybe it's by a little bit, but the fact that it has been ongoing for a few months, and that you can track it across multiple data sources, whether it's like the New York Fed or the the Cleveland Fed or the University of Michigan, there are multiple sources that are tracking improving consumer sentiment. Also, I would argue that sentiment is set to improve because so many people voted based on like their feelings about inflation and the economy, and their feelings may improve. Well, it's like, all right, I did this vote, I made this action, and it's like things are improving because because new people are in charge. So
there's change.
Yeah, there's change. Yes. As material or immaterial as it may be, because it's only days, so nothing material has happened. But I guarantee you, if you polled those people after voting, it's like, yeah, the new guys are in, things are going better. So
yeah,
and we'll see that. I'm sure we will. I am positive we will. I am sure that we will see the variance between the median and the average inflation expectation shrink back down. Before, it was at record highs because we had a bunch of people thinking that inflation was super high when it actually was closer to like 2.6 or whatever.
Yeah.
Anyways, those will come down. Things will maybe get a little more realistic. Who knows? This is my dare to dream portion of the Gray Report. But I don't think that there was like a straightforward partisan bias. I just think that, there obviously was. There was a partisan Republican bias, but overall, whoever you were voting for, if you're voting and the economy's on your mind and you're voting to effect economic change, then I'd like to say that sentiment is going to improve. And if you'd like to argue against me that like sentiment and feeling is unimportant, I don't know. I think that almost everyone, that's what's motivating people. It's a large part of what goes into decision making, whether you're an investor or whether you're a grocery shopper. But that's my own.
I wouldn't necessarily call it an outright disagreement as much as it is just a question over whether people's feelings towards the economic, I shouldn't say feelings towards economic sentiment, because that is kind of economic sentiment, but how much of that can really be changed in any way, right? Because I want to say on the Trepwire podcast that they have, I want to say it was June or July, they had covered a report where they were surveying different people on different economic measures and kind of throwing out economic statements and whether they believed it or not. And 50%, I want to say, were in belief that unemployment was at an all-time high this year. Yeah. And on that show, they were just kind of like, how can we really gauge economic sentiment when supposedly 50% of the country is believing that unemployment is at an all-time high when it's clearly not. And we've just had an election. Did anyone talk about that? Anyone talk? I always wonder what the difference between a lot of people are talking about. People followed their feelings in election, but people don't want to talk about how unemployment is relatively low because the risks of people saying like, oh, your head is in the clouds. Like if people think that unemployment is high, then like it's not going to really help them if you were to talk about how it's low. That's kind of my point. And so it's a little bit of a bind that you would find if you were to try to defend this economy. Well, and I don't want to get too much into like a personal anecdote, but when I was getting my haircut, I was talking with the lady that was cutting my hair, and we were talking about how Taylor Swift was in town this past weekend and how people were spending like $2,000 a ticket to go see her, and like families of four were spending at a minimum $1,500 to $2,000 a ticket, or sorry, $1,500 to $2,000 a ticket to go see her. And the person next to me just said, "Oh yeah, and the economy's bad."
Yeah.
It's just like, there's And I don't know how much of this was just a lack of social media or independent media or 24/7 media when I was growing up with the great financial crisis. But even if you weren't unemployed during that, there was sort of kind of this fear of I have a job. I don't know how much longer I'm going to have a job. I think there was there was a lot of that where it was like things are good, but I want to be really, really careful. And
I think after the Great Recession, people had been programmed for, because it lasted for so long, and regardless of like even outside of like the technical recession point, it was such a lengthy period where the economy and hiring was so sluggish, and I think it just like got set in people's minds like people couldn't really imagine that the economy could be that good.
Well, and
then right as it was getting good, like I felt like maybe it was gonna kind of turn around 2018 or something, and then a couple of years later there was another.
Well, and then I felt like there's a little bit of that this year in terms of, or I shouldn't say not this year, in this cycle, I want to say 2021 or 2022, you could kind of hear some of the anecdotes or see some of the actions taking place. I mean, I remember Katie Porter saying in Congress of how, like, she went grocery shopping with her kid and, like, kind of added up what things were going to cost and had to put a few things back. But I would say, thinking about last summer and 2023 and then this past summer, I don't think I really know of any people or hear of too many people saying that things were so expensive they had to stop doing it altogether. It sounds like people were still going to the concerts, still going on the family vacations, still doing whatever. And I know that my reality is not the same as everybody else's, but it just to be kind of told that this was a horror, this is currently a horrible economy. A lot of the anecdotes I hear from people don't back that up.
I think it's hard to make the case at any point. Get the clicks, get the attention, get people to believe you. If you're saying that things are going good, it's so much easier to say that to engage people based on fear than it is to engage people on hope. I think that's just human nature, and I think that extends to the clickability of a YouTube thumbnail. They're gonna click the ones with the atom bombs and the flames in the background. Yeah, they're not gonna click like a thumbs up and someone smiling.
Good news doesn't sell.
Yeah, good news doesn't sell.
Actually, now the more that I talk about this, the more I wish I could have pulled people outside the Taylor Swift concert and been like, you're going to this. What's your thoughts on the economy right now?
Yeah,
good, bad? What is it?
Oh, man, I don't know. It's just a struggle these days. But to return to the trajectory of the Fed's rate cut, what I've got here is a chart of the blue line here is the Treasury, 10-year Treasuries, and the red line is the federal funds rate. And you see they're kind of, they're at the very least correlated. And we're beginning, hopefully, what is a kind of lengthy period of declining federal funds rates. I think that general economic sentiment is different, obviously, than whatever balance of inflation and employment motivates the FOMC. But I still think that confidence, or like inflation expectation, whatever the like feelings portion, that's still a factor for them. That's still something that they are watching too, because their job is to communicate. And like the fact that people are hanging on Jerome Powell's every word, and that he has to carefully measure his words, that means that they are attuned to the perhaps psychological or irrational reaction or like sentiment reaction to what he's saying. So he's probably like, as a part of their managing expectations job, but as I think as a yardstick for the economy, it's a very imperfect, but it can help inform us where things are going. I think that's going to be a factor, but they're following but there's more powerful trends than that. I think that probably they've known by now that it's more easier to trust the hard numbers on inflation and labor than it is to look at and just to ask someone off the street or to get their opinions, because if we're talking averages, like we said last week and the week before, the average of inflation expectations like 4.7 or 5 or something, depending on what source you're using. And the reality really is the consumer price index was 2.6, 2.4, something like that, mid twos, maybe 3 if you're going with the core or something, but not 5. That's a lot. That's a big difference. And it just shows that, I think there's a staying power between inflation expectations, at least in this past, through the pandemic. And that has come up, I'm going to call an audible. and pull up University of Michigan inflation expectations, and we're going to see here the variance between the average and the median. All right, so I've got here the expected change in prices during the next year. This is what the University of Michigan is tracking as part of their consumer sentiment survey, and you can see the median increase. It's 3.2. Some in October of 2023, the median was 4.2, which was pretty high, and the average was, during this election season, a lot higher than the median. So if you look, this variance, which I'm taking to mean the difference between the mean and the median, this average is, this variance is incredibly high. It's like 81, 85, 81, 85, and that coincides with really the election ramping up in like May of 2024. That's when people maybe have started to pay attention, and maybe they've got fed some ads. I don't know. But all I'm saying is things are a lot different when you're looking at the CPI than when you're talking to someone that has said that, for instance, they think that inflation has increased by 4.4% when it has not, and the median person says it's 2.7%. That's a big difference. I just wanted to back it up with some data and just maybe guard against. Maybe sentiment's not everything. I think it reflects some important things, but you can't just trust the pure numbers. I think you just have to trust the trajectory of where things are going. So moving from
what would have been useful in that, I think, is to ask people when they think of inflation going up, or when they're asked about inflation. I don't want to say what inflation means to them, but I think there is a difference, but I don't think people are separating inflation from what they were paying pre-pandemic to now versus how have things gone from 2022 to 2024.
Yeah.
Like, I think if you were to ask people that really, I mean, you're doing it, a lot of us are tracking it, be it with different metrics, but anyone that's tracking the inflation situation, right? If you're tuned into some of the financial news, you're probably thinking, no, it's either still going up or it's not as much as it was, because why would the Fed be cutting rates or at least halting when it's a high inflationary environment? But I think if you talk to the average consumer that probably doesn't care about that, it's still in their mind that, you know, I'm paying more for a steak at the grocery store now than I ever was pre-pandemic, or at least in 2021. And I mean, I think that's going on across the board. You're still hearing people talk about expensive gas when, I mean, my dad filled up in Illinois for like $2.70.
Yeah.
So I think there's a lot of people where it's just stuck on things were this, now they're this. Situation hasn't improved.
Yep.
Just depends on what they think inflation is when they answer that question.
Yep, I totally agree. I kind of want to move it into a related section, which is job growth. And, you know, you're talking about inflation kind of fading, but job growth is a little shaky. And that has kind of created the preconditions for the Fed for me to have a lot of confidence that the Fed's going to continue to lower interest rates, because they're looking for kind of lower inflation, and they're looking to cool down the labor market in a little bit, and they're seeing that. And so I think that it gives them a little more license to keep things lower. We'll see how things go. But we're always in the situation where if it's too hot, then we're sad because interest rates will stay high. But if it's too cold, then we're sad because unemployment it's kind of recessionary, kind of. So there's some ambiguity and shakiness, but I think as I'll detail here, and I think as Nick Villa does in this Moody's Analytics article, A Tale of Two Jobs reports, there's some volatility associated with labor market data and a little bit of uncertainty. I think it pays, though, it's worthwhile at least to focus on some of these long-term trends that we've seen playing out in the labor market over the past few years, rather than looking at the past few months, because you're just going to see a lot of noise if you focus on too granularly. I'll give a characteristic quote, though, from Nick Villa. Maybe a little long, but I think it's worth it. Friday's jobs report stole the headlines. Now, this was a couple weeks ago for Friday. I don't know what headlines it was stealing, but things were a lot different a couple weekends ago. Stole the headlines by adding a mere 12,000 jobs in October. However, the ambiguous impact on the headline from the hurricanes and from the Boeing strike are reasons that the Fed may overlook this report and not focus on a singular month of data. No doubt, however, the labor market is cooling. I'm kind of paraphrasing here. Job growth has fallen to about 170K through October. Wednesday's ADP report had 150K jobs added. The BLS jobs report had 12K. I don't get it. I do think, though, overall, regardless of these differences and what he has identified as some really shaky month-to-month data, there is a clear downtrend in labor market data. I think that we'll get revisions that will resolve some of the discrepancy between the data from ADP and from the BLS, but I think that overall they actually tend to track each other. Now I'm bringing up here the total jobs numbers for both of these sources. Here, I'll bring it up on the screen here, and you see that actually they're pretty well in line. They may have a difference this month, where one is 12,000 and one's 158,000 jobs added. But it is essentially like, if you're looking at the long-term trend, you can really point to this. Now, what we're looking here is you've got two trend lines. They're both kind of they're sharing very similar trajectories. And I'll say this: I think that there has been a general trajectory of lowering new jobs since July 2021. I'm marking July 2021 because that is the point after the big swing. There was a big drop in new jobs, like it went heavily into the negative. There was a big spike in jobs that went heavily in the positive, and this is when things kind of like normalize. So you can actually read the data. I'm gonna for the viewers right now, I'm going to expand this to show the spike, and you'll see everything looks completely flat except for that spike. So yeah, we're talking about like, what, man, I don't even know if this is real. A million, five, oh geez. So just a lot. I'm not even gonna, but going back into the normal world, I think from July 2021, this July 2021 to now, we do see a clear trend, and that's multi-year. That's common between multiple data sources, whether it's ADP or BLS. The point that Nick Villa is making is that Friday's, and this is a quote here, Friday's jobs report underscores the volatility in the data, not only from the uncertainty around climate change and natural disasters, which is the hurricanes that he mentioned earlier, but also the declining response rates from both the household and establishment surveys. Great. That's great, Addison. People aren't answering the phone. They're not doing the surveys anymore. Why lie? It's not hurting anybody. Answer. If you get the survey, answer it. I don't know what the rules are. I don't know who calls who. I don't know if it's internet or not, but why are they not answering the phone? Why aren't they filling out the internet form? I think it behooves you. It can only help. There isn't a convincing sign that the response rate is going to come up anytime soon. Now, I'll bring up the chart that he has for it, which is really kind of sad. Like, why aren't people doing this? It's not so bad, right? Hey, don't you love answering surveys?
I don't think I've ever really been asked for them.
I don't like it. I don't think a lot of people like it, but I think they should as their duty. That you see these response rates. Now, this is comparing 2014 to 2024, but you see a big drop in the response rates. There is, for the establishment survey response rate, there's a big dramatic drop that coincides with the pandemic. But for the household response rates, this has been a fairly steady decline since 2014. Since then, less and less people every year have responded. There used to be 89.4% responded. What Boy Scouts we were in. Man, we were doing everything right in 2014. But now it's 69.5%, really, like, down by 20%.
Yeah.
Same thing for the establishment surveys. It was 63%. Now it's 43%. That means that the data is going to be a little bit worse, and that means that people aren't going to be able to make as good of a decision. I don't know how they're going to fix that, but yeah, I don't like that. Maybe we'll punish if you get that survey in the mail and you don't answer it. You will be punished. That's just an idea for the BLS, and maybe for ADP too. We can get some punishment. We have to. There's got to be a reward system or a punishment system. Otherwise, why would they even do it?
Do you have any thoughts into what those would be?
Yeah, you've got to. That's a good question. Oh, every day that you don't fill out the report, we will subscribe you to 3 spam email lists. That's not so bad, right? Want to give, I want, if that's what they're trying to avoid, that hurts them so much, then have at it.
Or one of those lists for people to text you that they're willing to buy your house all cash.
Exactly, that's right. You'll get 5. We'll give you 5 different people that want to buy your house, whether you own a house or not. That is what happens if you don't fill out these employment surveys. But back to the data from these. Again, we have been seeing declining employment data for since July 2021, and I'm going to zoom in. I have the unemployment chart here. It's not the jobs added. That's what we just looked at. Now I have the I'm going to put it in a thumbnail because it's just funner. And so you can see the general pattern here of unemployment spiking up during a recession, and then it gradually goes down. I've talked about this before in the Gray Report. I think it's still kind of worth noting right now. It usually happens that when unemployment goes up a little bit, it's just about to spike. There's a very rarely, if any, time in which unemployment is gradually going up. It's usually gradually going down. Fast goes up, slow goes down. But now, correct me if I'm wrong, and this may be a unuseful statistic, but I think that we are in the midst of one of the lengthiest periods of increasing unemployment in the history of the United States of America outside of recession. So that's my call. I think there may be some times that you can argue, but since let's say December 2022, when unemployment was at 3.5% until now, where it's at like 4.1%, the general trend has been positive. Now, it hasn't gone up a lot, but it's ticked up. Maybe it's 3.5, it's 3.6, it's 3.8. Slowly, every month, it's ticking up generally. Now, recently, the past like 3 months, it's gone from 4.3 to 4.1 or something like that. But that doesn't really give me a whole lot of confidence, because we're following such a lengthy period of increasing unemployment. Gives me a little bit of pause, but also like it makes it's something that hasn't happened before. We have never had this extended period of slowly rising unemployment, especially outside of a recession. So I don't know. It's good news. Maybe it's bad news. I would say, like, to me, it's worrying, because I see these patterns and it's looked like, oh, we're heading up. We're just like a couple months away from a recession, if you want to be cynical. But if you want to be optimistic, which a lot of people are, and consumer sentiment is improving, and I've just been finished talking about that, on an absolute level, unemployment is just about as low as it's ever been. Maybe in like the early 2000s, like April 2000, it was a little bit under 4. Maybe during the 60s it was under 4. But man, for between like 1970 and 1996, it was above 4. I mean, we are still like on an absolute level, on a historical level, unemployment is low. However, the movement is worrying. That's kind of my end take on jobs.
I don't necessarily disagree, but I know tracking a lot of those things in terms of sentiment is kind of tough during this time period, because I feel like the general sentiment around anything regarding an election is just, it sucks around election time.
Yeah.
And everybody's in wait and see mode.
That's a good point. And I also think that, regardless of whether you're going to look at the absolute level of employment or the long-term trajectories, or maybe we are in an uncertain cycle that may be longer or shorter, however you look at it, Nick Villa does point out that wage growth still has not caught up with inflation. If you're looking throughout the whole span from pre-pandemic to now, our dollars aren't going as far. Wage growth has not caught up on an absolute level. Now, since October 2023, income has outpaced inflation, but again, I think that's part of people's feeling of inflation still in effect, is that like on an absolute level, if you sum it all up, our dollars aren't going as far. I'm not getting paid enough to afford your quarter pounder, your eggs, your what have you.
Well, and also, I mean, it's a measure of, and I'm not using exact numbers here, but if your expenses go up 10%, your raise was 5%. You still don't feel like you've made any progress.
Yeah. No, I think that's totally true. And let's look here. He has this this ECI, which is the Employment Cost Index, and that's a way of measuring how much your earnings are kind of going up relative to inflation. And you see, before everything's kind of in line, and now it's dipping down, and it has dipped down below the kind of water line, as it were, and it still hasn't emerged above it. Whereas, the CPI and the nominal ECI, as opposed to the real ECI, those are still just kind of going up linearly. So we've got some inflation struggles that we're still dealing with.
Going back to the reference that you made, going to the quarter pounders or whatever. I also wondered during inflation, and I really wonder what products or what things have to rise in cost for people to really feel it. And
there's a charismatic piece. Things like everyone. I like to talk about eggs because I think that's kind of ridiculous. Like, to pick one product, is that what you know what I mean? To represent all of inflation when it really could be, the chicken or the bird flu or whatever.
Well, not as much that as I am. I feel like one of the biggest things that have come out is just the price or the cost of going out to a restaurant or eating out.
Yeah.
And it seems like since we've had this run up of inflation, a lot of people say I can't believe how expensive McDonald's has gotten. And McDonald's is, they've kind of compared it now of depending on what you get at McDonald's, it's cheaper to sit down at a Chili's and get a burger and fries or a burger and chips there.
Yeah.
And so there's never going to be talk of I can't believe how cheap it's gotten to eat at a restaurant like Chili's now. It's always going to be I can't believe how expensive McDonald's is.
Yeah.
But with that being said, I wonder what types of products, and for all I know, there could be no change whatsoever, but what are those things that kind of make people notice the inflation more than...
it's like when there's endangered species, there's charismatic endangered species, which like the polar bear or the panda or something, where it's very noticeable, and where I think McDonald's is very noticeable because that's supposed to be cheap. But if Culver's, let's say which is a little bit more of an upscale hamburger place, if their prices,
it's the best in the Midwest.
It's a Midwestern, very good McDonald's alternative. And what I was thinking is, it's McDonald's prices are coming up almost to meet that next tier of fast casual places now. So that's kind of interesting. And then you notice when the cheap stuff starts getting expensive, you probably do notice a little bit more. I do want to say, we've got that wage growth. I just think that when we're talking about job growth, and I just like this article from Nick Villa. It is another great article from Moody's Analytics within what I informally call the Thomas DeSalvia School. He leads the research at Moody's Analytics. Just very well written, interesting, not afraid to throw in some Dickensian analogies. There's a lot to like in this report from Nick Villa and in just the general school of Thomas DeSalvia at Moody's Analytics. Again, that's an informal name, but I kind of want to get that going. Really like their work there. Moving on to the real deal, Arbor Realty. We move on from kind of a research to this is more juicy. I want to frame this before we start talking about it as, I think that people know this source, the real deal. It's a little bit more, it's really more juicy takes, I guess. They're not afraid to make things a little, kind of exciting, I guess.
I'm gonna sound like a real dork here. They have great graphics.
Oh yeah, love their I know. Yeah, really good, really good. And that's not AI. Someone's probably doing that.
Yeah.
Really interesting data point here. This is Arbor Realty takes back more assets as loan mods slow and delinquencies persist. Lender says it outperformed peers, but analyst asks if dividends are sustainable. Really interesting data point here. Just one example, I guess, of the consequences of extended pretend that we talked about last week. It was a very timely report from the New York Fed that cautioned against the costs of extended pretend, and I think that we'll see that I think that if anything, the real deal dramatizes this well and really points out you take a look at this. The news from Arbor Realty for all those greedy sharks out there looking for great multifamily deals, it looks like extended pretend tactics are not like a cheat code for doing good CRE investments or for running like a lending operation. Like it's not like you get out of it free. That's kind of what I want to say. If there was a cheat code, let us know in the comments if you have any cheat codes for investment. That'd be just worth looking into. I just don't think that extended pretend as a tactic, whether metaphorically or not, would really function as a cheat code. Arbor Realty is a REIT that is focused on giving out the loans. It gets the real estate part of REIT because the loans are for real estate. Specifically, writes the real deal here. Arbor Realty is a top bridge lender to multifamily syndicators. We wrote about this at length and discussed it on multiple Gray reports last year about the how there was like a perfect storm when it comes to bridge loans, where people got really excited, got these bridge loans. Maybe they were adjustable rate bridge loans right when prices were highest, rates were lowest, and then what happened in the course of, man, it just looked like an eye blink. Prices went down, interest rates went up, and that meant a lot of people were underwater. A lot of people had a bad situation.
Yeah.
And Arbor Realty was the lender in a lot of those cases. And like Spencer said before, and I've said too, it's like not these guys' fault if they fall on the wrong side of this. This was a whole market phenomenon. It's naturally did happen. And I think that's part of the reason why we still think that there's going to be opportunities in going forward. Like, yes, there was a wall of loan maturities that we had predicted would happen in October 2023. Didn't happen, I think, because of this extended pretend. The upshot that we talked about in the New York Fed is that, yeah, it was scary then because it was maybe crisis. But now the economy is a little bit more robust. They can handle it. Maybe they can get a little more strict. Or arguably, it's not about strict in economic terms or anything like that. Like, it's not about your duty to the health of the economy. It's about your duty to the bank. It's about the bank continuing to make money and to be solvent.
Yeah.
And I think that the rubber is hitting the road, or people are getting real in a way that they weren't in 2023. And it's resulted in, for Arbor Realty, it means like they're starting to do foreclosures. My thought, again, was about this different economic, but ultimately, yeah, sorry. It's about foreclosures. That's a real upshot for everything. Arbor Realty did give some extensions to some of its borrowers. They mentioned, I think it was like $1.2 billion in Q1, $1.5 billion in Q3, or in the billions. I'm sorry, $1.9 billion of loans were modified in Q1 of this year, $1.2 billion in Q3 of this year. They didn't include the Q2 data, but I'm sure it was big. They are still extending these loans. But at the same time, they're getting delinquent payments. They say that Arbor Realty wiped out $300 million of loans. I don't think that means that the $300 million just was paid back to them, but it does seem like, at least in the structure of the loan, whether the modification, extension, whatever, they're not as much of a worry. That's great. But then on the next sentence, they say they've got $225 million additional delinquencies that were added. Add to that the fact that they have had all these extensions. Extend doesn't mean... again, it's like not a cheat code. It's just like, we'll deal with it later. I think that actually, though, the extensions made now maybe will be a little bit more successful because there's a lot more positive prospects for multifamily. But if these extensions were granted in like, I don't know, early 2022 or something like that, or if these extensions were made a couple years ago and then they're coming back for more, how many times can you do it? And like, can you do this you can't do it forever. You have to, at some point, you have to get the money from the lenders. And that's why I say it all leads to foreclosures.
I don't disagree. But it seems like in the conversations I've had with people that monitor this or would be kind of on the debt side, it seems like really ever since when the prospect of this was ramping up in 2023, I felt like in 2022, headed into 23, people were kind of gearing up for like, all right, we can start to see some distress this year.
Yeah.
We know people are going to have issues. Didn't happen in 2023 at all.
Mm-hmm.
And then in 2024, it was like, all right, now you're going to see a lot of this stuff come to the market. And I think brokers could probably tell a different story because they're getting a lot of the BOV activity. And so they're seeing a lot of deals before we ever do, if we ever do.
Yeah.
So they can speak to it differently than I would perhaps. But it seems like even in 2024, in waiting for that massive wave of foreclosed or distressed properties to hit the market. It doesn't really seem like it did in the way that I think it either didn't at all in some cases or just didn't hit where as much as people thought.
Yeah.
But going back to a great piece that the Trepwire podcast had talked about a while ago was extended pretend really isn't a good term to call what's going on now.
Yeah.
Because the real extend and pretend kind of took place in the financial crisis where the economic situation got so bleak that a lot of these lenders knew they weren't really going to recoup their money, or there wasn't really a plan forward.
Yeah.
But it was a scenario where they really didn't want to take all of these troubled assets back. That was just kind of ground zero for them.
Yeah. Yeah.
In this case, I think the sentiment on a lot of the lenders and a lot of people is that a lot of these properties could be performing better if it wasn't for the jump in interest rates.
Yeah. Yeah.
Now, with that being said, there's a reason why they missed the mark on they could have missed the mark on rent growth if they projected 7, 8, whatever % rent growth in the Sun Belt and then all new supply came up or whatever. But there is some sort of belief that if it wasn't for these external factors,
Yeah.
they would be fine.
Yeah, things are on a little bit better footing, even considering the pandemic versus the great financial crisis. Yeah.
Right, and I don't think anybody, very few, if any, people aren't bullish on multifamily moving forward.
Yeah. No, that's a really good point.
Forward.
But I will say there is a little bit of pretending. I think maybe this is implication. Arbor Realty has not really put up a loss because they haven't sold the properties that they've taken back from borrowers. So I feel like that may be the pretend part of it. They haven't realized their losses yet, but maybe they're coming if they ever do sell these. They're called like real estate REOs, real estate owned assets.
But I mean, if they could lose money, they also could not.
Yeah, if they hold on to them and they do it right. Yeah, that's right. It actually, I think you are right, because I was like, some people may get away with this just because there are things that are improving. People's appetite's a lot better than it was even just like 9 months ago. No, very good point. I want to say shaky prospects maybe for Arbor Realty, but look at this. If you're on the YouTube, you'll see it, but I will describe it for all of our podcast listeners. Arbor Realty REIT has not suffered. The price of that has not been impacted really meaningfully by the news at all. It has gone from $13 from the beginning of the year to $15.55 now, and that's like the price of a share of this REIT. And so they're not. If you're just looking at their price, the market has spoken, and the market has faith in Arbor Realty. So, what's this really mean for multifamily investors? At the risk of repetition, the issue of loan maturities is not yet over, in part due to these extend and pretend tactics, I would say, or just extend tactics. I think opportunities will continue to emerge for investors. They, 200 million, 300 million in delinquencies here and there. That's a sign that it's not like everything's going great. So there may be opportunities here and there. They're just going to continue to be a factor. I don't think they're going to pop up like crazy, because if they did pop up like crazy, then we'd be looking at a downturn. We'd be reading a lot of horrible doom and gloom headlines. But I don't think that that's the case. I just think that it's a case of like keep your eyes open. It's not uncommon. It's just a feature of the market, not a characterizing element of the market.
And even then, from kind of a ground level view, with what Jay and I do on a day-to-day basis, I feel like it's very rare to see deals come through where they're underwater, they really need help, they've got to get out of it. If anything, it's more so just kind of newer developments where it's the business plan, we got to get out. We got to get out because this isn't what we do. Buying and building and holding for a long time is not something that we work on.
Yeah. And they
So
said that too.
sell.
Like they mentioned that in there. They're looking for syndicators to assume these loans, and but also there's just this unspoken question. Maybe it was spoken, and because there was a couple times where it was like Arbor Realty declined to comment. This question of how long can you hold these things? What are you gonna do with them? Because if you sit on them and you don't do anything, that's gonna cost you money, obviously. So what's the deal with apartments? Oh, that would have been a great name for this podcast, but
Cue
that's for the
cue the Seinfeld riff.
yeah, exactly. That's what I was gonna say. Again, yeah. So some opportunities may pop up, and the issue. I've just been surprised in the past, like literally like 3 weeks. The issue of loan maturities seems to have kind of like reemerged in the discussion in a way that I wasn't really expecting. I was like, all right, we called it for October 2023. Didn't really happen. I know we didn't call like a whole transformation, but like I was a little underwhelmed. Yeah, so it still may be a part of the
I'm
market.
not as well versed on 10-year Treasury history as I probably should be, but
Yeah.
I think a lot of that has to correlate with where the 10-year's headed.
Yeah.
Because around October of 2023,
Yeah.
That's when we were looking to do pref equity, because it
Mm-hmm.
seemed like a lot of people were going to look for those avenues and people were reaching out. And then it seems like as things cooled off a little bit, kind of faded away. And then December picked up a little bit interest into January and February. But that's when we got a great deal,
Yeah.
a great basis with River Club. And I think kind of you start to see the ebbs and flows of the 10-year start to kind of increase people's fears of we might have a problem here versus the like, all right, everything's going to be fine.
Yeah.
So if the 10-year continues to go up, and I'm not predicting that it's going to be at 5 anytime soon, but if the 10-year continues to go up or it doesn't drop, I would not think it to be too surprising to see loan maturities come back into the play.
No, that's a good point. All right, so we're talking about these general economic things. I did tease. This is not exactly breaking news, but just for people that weren't following, there was an election this week, and Donald Trump was elected president of the United States, and yeah, that has some relevance to the commercial real estate market, not the least of which is Donald Trump's background in commercial real estate. Biz Now has an article, CRE readies for realignment as Trump surges back to the White House. There's an article from the New York Times, what Trump's win means for Fed independence. And Realtor.com has an article, Donald Trump will return to the White House, what his presidency means for the housing market. We'll talk about all of those as a group here, and we'll try to get through them real quick because I'm sure that there's been a lot of talk of this election, and this is maybe not a priority for a commercial real estate focused podcast, but very, very relevant issues, particularly with interest rates. I'll just skip to those because that's what we're kind of talking about. I remember in 2018, during Trump's first term of presidency, he talked a lot about wanting to get the rates down. He was like, get them down. And there was like, oh, he shouldn't be talking about that. I was like, yeah, you try and stop him. That's his deal. That's like his big thing, is talking about stuff.
Talking about things he shouldn't be talking about.
Exactly. And one of which is this like decorum of, yeah. But I think that Jerome Powell's like, yeah, I know. He hasn't said that he would like fire Jerome Powell, I don't think, like explicitly. He's probably bandied it about. What doesn't he bandy about?
Well, listen, I do think it is very telling, some of the comments that Jerome Powell made
yesterday. Yeah, what?
Well, if I'm not mistaken, he said if Donald Trump asked him to step down or whatever, he wouldn't. And
that's fun.
He also reminded everybody that like he does not have the legal authority to fire him. It's independent from the presidency. So, for the loyal listeners of this, one of the last times I was on, I'd speculated that I don't think Jerome Powell is an extremely political person. But I think he was definitely staring down the barrel of one of the options in which he could be working for, and was probably hoping to have a more shouldn't say more,
like a less involved
less involved, less dramatic situation. And I think he's aware of what pressures could be coming his way, and for those listening, it's not to make this a political opinion, but we just touched on the fact that Trump has not shied away from making those comments in the past of getting the rate down, or
he's going to do, if anything at all, there will be greater pressure for lower interest rates. It will be like an additional pressure of like inflation, employment, and Trump.
And so
all are Ahab.
I think Powell knows what's in the near term, and he had to remind some people of how this is, what powers he has.
Yeah, for sure. I also think that like in general, and they may allude to this a little bit. They talk about immigration and other aspects of Trump's platform and whether that'll work or not. You know, they mention like deportation, and we talked about this in our review of a Harvard Joint Center Housing Studies thing about how immigration surged after home prices surged. So there's not really, if anything, you may say that they caused them to go down. But that's stupid. It didn't. They're just not related. Immigration was not related to the home price growth. What they do kind of hint at, perhaps, is that if you get rid of a lot of these immigrant workers, that may make it harder for us to increase the housing supply. I don't know either way. I just think that the numbers have shown that the immigrant surge did not have the impact in housing prices that some people may assume.
No, and
So that's just one plank, though. We got a lot more left.
I remember back in 2022 listening to Sarah Longwell for the Bulwark has a really good podcast where she just does focus groups with voters and listens to voters.
Yep.
And I remember a woman in Alaska talking about, one of her biggest concerns heading into the 2022 midterm was the southern border.
Yeah.
And I was just thinking to myself, like, in Alaska, that's the
Yeah.
biggest
Yeah. Well,
worry.
yeah. I know.
In that, though, I can definitely buy the impact that immigration would have, illegal immigration could have on the housing supply in terms of construction costs and where they can get the labor to build these homes.
Yeah.
But just in the aggregate, I don't think in Carmel or Zionsville.
Yeah.
that's
Well,
what's driving up the home
and
prices.
funnily enough, Realtor.com has a quote that it was almost like not word for word, but definitely touched on the exact same stuff that we talked about last week on the Gray Report. They said, in reality, the evidence in immigration is a major factor in housing costs is mixed. While there's reason to believe that higher immigration levels can drive up local rents in a city, the recent post-pandemic surge in home prices began before illegal immigration levels jumped. Basically, yeah, for a city, if a city has a lot of influx, then that may affect it. But the numbers just aren't there. Maybe the numbers, maybe their respondents are wrong. That's one of the things Trump's going to fix is these numbers.
I'm just saying, it goes back to, I guess, to some of the original comments. I mean, if it was expensive for you to try and buy a house in Maryville, Indiana, and now it's even more expensive, I think we can rule out immigration.
Yes, but
as the cause.
Another thing I did want to, I forgot to have this call out. I wanted to say, I'll just bring up the 10-year Treasury and the federal funds rate now. Now, Trump's going to do his job. We'll get this Fed funds rate down, right? Let's hope he does the same thing for the 10-year Treasury. Did I say 10-year Treasury both times? Well, I think that he has the power to do whatever he can to get all of those numbers down. That's all I wanted to say there. Now, sorry. There's a lot of plans that he has made. I'm saying this a little bit facetiously. I ultimately think that the president is very limited in the powers that he has over the housing market. It's more of a mayor thing, especially when it comes to the all-important realm of zoning. When it comes to housing demand, the pandemic and remote work arguably had more of an effect than the administration, than whoever was in the presidency at the time. And Jerome Powell arguably had a stronger role in creating the housing conditions than a president would have. All of those are separate people. They're nominally at least independent. We'll see how independent they are. But I also would caution people expecting to see an instant improvement in everything, because that's just not how the economy works. That being said, if we're talking about sentiment, a lot of people voted on the economy, and if they're voting for change, then and the parties did change, then maybe they will have that feeling that things are better.
Well, to go back on a topic that we touched earlier on inflation and when does it hit what items, what increase in the prices for certain items hits people, what doesn't, what's noticed, what's not. If prices remain elevated, and I think they've been elevated long enough, I think a lot of people would agree with that. But if we're having this conversation in 2026 where people are still they're not happy with the price of eggs, or they're not happy with how much it costs to go to McDonald's or whatever. At what point do people? At what point does it settle in of just that's just what the price is right now?
I think that, and this is another, again, like this is me speculating kind of
Because
the psychology of American is like sometimes you would need a break, and if people think like, oh, the Biden era was the era of inflation, of pandemic, then maybe we get rid of that old stuff and we'll bring in the new stuff, and mentally people will think we're in a different era now actually, oh wait, I blocked that off, and starting here now it just seems like things are going to be different, and maybe that's all it takes. But again, like I think that ultimately the commercial real estate industry is probably pretty happy that Trump's in the office. If he was a commercial real estate guy, outside of partisan concerns, they're probably a little bit excited for what he can do, and maybe he would listen to commercial real estate interests. Maybe there is some going to be, it will be directly relevant to questions about carried interest laws and things like that were like in the offing. I remember, what is it? There was like, there's different, there were different things, capital gains, whatever, all of these little levers that made commercial real estate investment advantageous from a paying less taxes standpoint. They were getting kind of dialed back a little. I don't think that Trump's going to dial those back. He may make it even more advantageous from a tax perspective.
If I'm not mistaken, I think there was talk of looking into bonus depreciation.
That's what it was. Yeah.
So I don't know. I haven't heard his exact thoughts on that, and also I don't know how much of that is going to be a priority with him when he gets into office. I know one thing that it seemed to be the one thing that they could really agree on. The GOP could agree on in his first term was tax cuts, and so if he has he's going to have the White House and the Senate, and if he does indeed have the House, then they're going to be in control when a lot of those things are set to expire in 2025.
Yeah.
So I don't know if that's going to fit his priority, or if there's going to be other parts of the tax code or other deductions or whatever he wants to tackle up front. But when Biden was trying to hold on to the nomination, and I think when Kamala Harris was trying to get people jazzed up and ready to go, there was talks of rent control or national rent control.
Yeah.
You're not going to hear that from Donald Trump. So
I don't think so. Yeah.
I personally was never really worried about the rent control from a national level. I've always considered that to be something that if it does get implemented, it's going to be at your city or county or whatever.
Well,
level.
and California notably just voted down Prop 33, which was a rent control proposal. So
and so, had we woke up on Wednesday to a different election result, I don't think we would have been any closer to rent control. But you're not going to hear that rhetoric or proposal from a Trump White House.
Yep. True.
Now, that'd definitely be a separate episode from here, but I think there's already been some guidelines or some plans that I think Ben Carson would be returning to as HUD secretary, I think. And so I think there's already some things that they've touched on there. But yeah,
interesting. I would much more expect
no rent control.
Yeah, exactly. I would much more expect them to err on the side of increasing supply, and then try to kind of punish or limit rent growth or anything like that. Or I think deregulation is a little bit of a double-edged sword. I don't know how much deregulation you can have before. I'd like a little deregulation in a building so that, like, when I slam the door, the building's not going to fall down, or it's not going to flood, or like maybe I'd like to know if some contaminants were in the soil before the building was built. There are just little details like that where I hope they keep some of the regulation, but maybe there are others that can be cut around.
Well, the deregulation that has been talked about in the housing plans are mainly the permitting, but I think it was BizNow or one of these articles, he touched on he was going to cut home prices, or at least the construction prices on homes, like 30% or in half. And somebody said the permitting process makes up like 7% of the cost. Yeah. So if he does that, I think I think that would be great. I think there's a lot of zoning issues, but again, I don't know how much power he has at the federal level to fix the zoning issues in New York City. But if he gets involved and they're able to fix some of the permitting issues, I think that helps a lot, because I'm a firm believer that more apartment construction is a good thing. From the renter's perspective on pricing. But I also think, and I mean, we've seen this happen with just locally here in Indianapolis when they want to revitalize neighborhoods and when they want to get construction going, they throw out TIFs, they throw out tax abatements, or we'd like you to use these materials in building it. California's done a fair amount of affecting change in terms of like building things greener by implementing laws that you have there. Obviously, your solar tax credits, but also mandating that new buildings past a certain date have solar energy components or whatever.
Yep.
I think it would be great if, from a HUD standpoint, they put more of those incentives out there and continue that, because I think that's going to continue new supply and new construction in an interest rate environment right now where people can't make things pencil.
Yeah, whatever makes it easier to build houses, I think that's great. Safely, as the caveat. I want to kind of move along though. Because I think there's going to be more by the day that we learn about the future administration. I think that these issues are actually really relevant and actually help kind of do frame my expectations for the administration. Like when I learned, it's like, well, for our industry, I don't think there's going to be doom and gloom. And that's as good a segue as any to this PwC ULI report, Emerging Trends in Real Estate 2025. Now let's get these cover for everyone. The takeaway on this, which was written before the election, and again, like we've noticed these positive movements for a long time. These emerging trends they're positive. They're like, it's time for an upswing. Basically, is the takeaway for this whole thing.
Yeah.
Sharply optimistic trend for the profitability of CRE firms. Now we'll go here. This is all of the ones that think it's going to be that their profitability will be will be poor. That's going down.
So the groups that think it's going to go down are probably the people with the bridge loans at Arbor.
Yeah, exactly. Yeah. Those bridge loans, they're a shrinking population, but there are fewer people that are thinking it's going poorly. There are more people that are thinking it's going to be good or excellent. That's one real takeaway. I've got to fly through this because we spent a lot of time and a lot of things have happened, and we gotta try to fit as much as we can in the Gray Report. So we're not going to be able to cover all 138 pages, but I do think that some of their like takeaways are a little bit, I don't want to say like overly generalistic, but there was a recent CRE analyst post that had the title and the takeaways from previous editions of this Emerging Trends in Real Estate. And last year, the report said a new era comes into focus, but like it didn't, did it? I think that the point of that I've learned in this past year is like, it's like things are taking a lot slower than I thought. The cycle is moving a little slower than I thought. I thought that things would be kind of moving forward, but they didn't. I think that may have come the new era was coming into focus, but it was still far away. It wasn't there yet, and now maybe we're here. That's what I would like to say. I'd venture to say here, and that's kind of largely what they are saying, according not only to their own like assessment, but this is based on surveys with a lot of industry insiders, investors, the people that are in the retail real estate, office real estate, multifamily real estate industry, including Carl Whitaker, a friend of the Gray Report, Paul Fiorilla, a friend of the Gray Report, wrote the multifamily section, and there is one more person there too. I was looking for all the names of the contributors. I was like, and we also have John Shang from Marcus and Millichap. So with some real heavy hitters, some real familiar faces in the Gray Report. If only they could get Thomas DeSalvia and Nick Villa on there, that would have been great. But
and Jay Parsons.
Jay Parsons, well, I looked for him. Why isn't he on there? He's kind of doing his own thing, separate from RealPage. Maybe that's the reason, but I was disappointed not to see him in the list. But maybe that's not to say that I'm not following him very closely. And he does have a great podcast now, The Rent Roll. I'll plug that as much as I will plug the Gray Report newsletter, graycapitalllc.com/newsletter. Sign up for the Gray Report newsletter and stay on top of all of the most relevant reports, news articles, ideas, events, anything relevant to CRE. I take the best of it, I put it in the newsletter, I send it to you on Thursday morning and on Sunday. And really, everything that I'm talking about here, if you read the report, you'd already know all about it. So, so that's just one takeaway. It's free and it's really great. Got really great reviews. So I don't stop doing that. I just do that in addition to the Gray Report podcast. Just want to give that quick plug as I'm also plugging the J.
Well, and speaking of the podcast, I was told out there by you that if people leave a 5-star review on Apple Podcasts, you'll read it on air.
Oh, I can do that. That's fine, and I will. I promise you, if you do leave a 5-star podcast on Apple Podcasts, I will read it on air, barring inappropriate or incendiary language. I want to give myself a little bit of leeway here.
5 stars is 5 stars.
That's good. Give me something for these 5 stars. Yeah, that's right. But to return to the PwC article, and again, I can't cover everything. I do want to skip to some of the pages that I had marked myself as some kind of interesting little additions that can help people just kind of figure out what people are thinking about CRE according to this report. Now, one of them is they expect inflation to improve. They expect cap rates to go down. They expect prices to go up, and there's also a reminder that loan maturities have not necessarily gone away. Now, I'll tell you this quote specifically. One topic that is not top of mind for industry participants is the wall of maturities of CRE properties with maturing debt, estimated by TREP to top $1.2 trillion in 2024 and 2025. This includes a large pool of assets worth less than their debt, particularly in office. Much of that debt was rolled over in the timeless dance of extended pretend. Now, that's the kind of writing I like. That's DeSalvia, I feel like.
They know their audience.
But yeah, so I think that extended pretend has continued to make loan maturities relevant, and it's still a kind of hot topic, more or less. Now, I want to also scroll down to this chart they have, graph of migration patterns. They have categorized the groups of these markets as ones where migration used to be huge and now it's going down, or as ones where migration was down and still going down. But I want to pull out a few that I thought were really interesting before. So just for example, previously strong in migration, and now it has gone down. So things were going great, and now they're not going so great. People are moving out in Orlando, Southwest Florida, and Tampa. Places where they were moving in a lot, and they're still moving in a lot, are Charlotte, Raleigh-Durham, Nashville. Places where, now this is my favorite because it includes our hometown.
Sorry, I'm surprised by Myrtle Beach on here.
I was like, where do they draw the line on these markets? That was one thing. I was like, they don't talk about Louisville or anything like that, but they're going to include Myrtle Beach. And that's what one of the things. So I'm going to note here, positive migration that's now accelerating in Boise, Indianapolis, and Las Vegas. Indianapolis and Minneapolis are the only two that I can see right now are the only two Midwestern markets all right, I'll include Chicago, which has actually, Chicago seems to be middle of the road. But we get 3 Midwestern markets: Minneapolis, Indianapolis, and Chicago. But we also get Myrtle Beach. I don't know if there's like a population cap or not, but these are the markets that we deal with.
I don't want to knock people's hometown or whatever, but are a ton of people going to Myrtle Beach for vacation?
Well, that's
are
a ton of people going to Indianapolis? Well, they are moving in, and they're accelerating. So again, Boise, Indy, and Las Vegas are places where it did have positive in the past, and now it's only getting stronger. And Minneapolis joins Indy as a place where it's now getting positive in migration. But the only thing is that before, Minneapolis didn't have a lot of in migration, so it's kind of catching up. Whereas, and this is kind of how it was for Indianapolis's multifamily market, where it kind of peters along and then it increases, but it never really dips down like the more volatile markets like maybe Orlando or Tampa. So that's I just think it's really interesting that you can get this kind of ratchet effect. I want to say it's just because Indy's so great, but I think it's a combination of low cost of living and a stable economy and just this general stability of a lot of these Midwestern markets. That has allowed the growth and migration, made it an attractive place to live. If housing costs are a big factor, I always thought, well, maybe they'll move somewhere where it's cheap. Now, people still continue to move to Charlotte and to Myrtle Beach, but they're also moving to Indianapolis, which I think is promising.
I mean,
for my hometown.
I think if it continues that trend of if you can command a Chicago salary but work out of Indianapolis. Yeah.
Oh, that's a really good point too, because I almost was like, all right. This is where I'll stop, because I will save a discussion of the multifamily specific for Spencer next week. But this idea of remote work is not an idea that lives purely in the past. It surprisingly, remote work has gone from 34 million to 35 million from this past month, and it looks like. Just looking at this chart, it looks like remote work is kind of here to stay. It's been it actually ticked up. If we're comparing July 2023 to July 2024, which is the latest that we have the data, it went up 5 million. So remote, there may have been a push for return to work that seesawed back, and now we're at this point where remote work, they haven't beaten everyone back into the office, is my point.
Well, and I would not outright claim that there won't be a major return to work shift down the line.
Yeah.
I just can't see a trend or something that would happen down the line that would cause that.
I think that remote work is also, and return to work, it is also an expression of the labor market. I think as the labor market loosens, it starts to favor employers. Then employers are like, guess where you're working? Not at home.
Well,
I want to watch you as you type.
I don't disagree with that, but less people in an office.
Yeah.
Less overhead.
Yeah. No, I know.
So
You're right.
I think there's enough of a if you can decrease your footprint, I think you can get some executives behind okay, we don't need to have as large of a footprint, or we don't need to have some of the fixed costs or whatever that we were doing, on top of the fact that I don't know of too many people that don't ever want to work from home.
Yeah. Oh, yeah.
So to some degree, I think people like that flexibility, and I think it's going to be here for a while.
I think that, but I also think that on the whole, especially in the CRE market, bosses like people in the office. Like, you have to.
Yeah.
Right. If they didn't have to pay for it, especially. And maybe they do work harder, and I think. Maybe they work harder in the office. Who knows? There's studies that go either way, but I probably think that they may work a little harder in the office, but there's probably a benefit. They don't have to commute or whatever. But I guess that's a discussion for another time. The point that they were making in this report was they were connecting the return to office with the accelerated growth, really, of the suburbs and exurbs. Mm-hmm. So as they're, you don't have to don't have to go downtown, then you can live farther away. That's something that we noticed in the pandemic, in the emergence of remote work at the very beginning, was a coincident increase in it wasn't as if people were moving to Boise, or they weren't all moving to the mountains or whatever, or let's say what's this, Asheville. They weren't moving to like places where they could go hiking or to the beach. They were moving farther from their workplace. So it wasn't a move a state away. It was a move maybe a county away or just like into the suburbs. That seemed to be the trend.
I mean, that's happened a lot for people at Cummins in Columbus.
Oh yeah.
I mean, there's one of those things of either people can go fully remote or a matter of we only need you to come in once or twice a week.
Yeah.
Or once or twice a month. And in that case, you can live in downtown Indianapolis.
You don't have to make that trip every day. Yeah.
If you only have to go to Columbus once a month.
Yeah. The growth of the suburbs and the exurbs could also be demographically related. I know that there was a lot of like delaying of home buying or something like that, where and there is a outsized amount of a number of millennials that want to buy homes, and that's a natural place. If you want to buy this single family home, maybe in the suburbs, it's a little cheaper. So there could be a demographic association with that. That kind of remains to be seen. I don't want to count the office out. I do think that it's definitely competing interests between employee and manager of whether remote work will last. I think that, we will see probably a little bit of a uptick in return to office, perhaps. But going by this chart, it
doesn't look.
It doesn't look. Yeah, it really doesn't look like that. Look, in October 2022, there were 27 million. Now there's 35 million in July 2024. And it's not as if the pandemic got worse. This is so. Who knows? I wonder if there's something different about the way that they count that data. They are including hybrid and remote work, so maybe the fact is people are going to work. People have like one of the days that they're working, and they count that in the 35 million. Where on balance, more people are using the office, but it's just they're using it 4 days instead of 5. That's my generous interpretation. It seems to be seemingly more realistic, but who knows? I will, just as a little bit of a teaser, the multifamily portion was written by Paul Fiorella, whose Yardi Matrix reports we tend to cover like every month or so here on the Gray Report. They do come out every month, and so we're pretty close to that. A lot of the themes of high supply a little higher than demand. We've talked about this. The supply is going to come down. My guess is that demand's a little bit more persistent. So we'll see how that goes.
Supply is also going to taper off.
And I'm sorry about that. Supply will taper off. You mark my words on this. And so I think that, investment prospects for CRE, for multifamily specifically, are improving. Big changes are afoot. Big reasons to get optimistic. And that's not even thinking about the election. I think that, we're in the head of we're at the start of a new era, and I'd rather be optimistic than cynical. So thanks again for this week's episode of the Gray Report. Again, if you'd like to subscribe to the newsletter, go to www.graycapitalllc.com/newsletter, and you'll get articles. You'll get everything in here in handy email form that you can just read. You don't have to listen to my voice. Or if you like to listen to my voice, or even see me and Addison and famous guests like Jay Reeder and Spencer Gray, you can subscribe to the Gray Report podcast on Apple Podcasts or Spotify, or subscribe to the Gray Capital YouTube channel, and you'll get this arriving right when we release it every time. Stay up to date.
And you'll read their 5-star reviews.
I will read your 5-star reviews. I will allow myself a little bit of editorial control, but I promise you'll be the bare minimum. And if it is funny and a little inappropriate, I will consider reading it. That's my promise. See ya. Have another great week. Thanks.